All right, folks, part 4 from chapter 3, a little bit more about all this legal stuff. So you can also have negotiated settlements, basically out of court. They agree, but basically they agree to come together. They decide, okay, let's just get this over with and come to some sort of negotiation. You can also have mediation. So in mediation, the third party doesn't decide anything. Basically, they just assist both sides. And then arbitration is when an independent third party acts as a judge or jury. It can be binding or non-binding, okay? So, again, these are ways to basically keep it out of court, out of the civil proceedings, okay? Now we're going to talk a little bit about accounting, finally. Balance sheet, income statement, statement of cash flows, accrual accounting. So I'm guessing if you're in this course, you obviously have a good idea what this is. And what they're going to do here, they're going to talk about different ratios you could look at. So these are about different transactions, things like this, operational activities. These are the types of data that they're going to look at, all about records and contracts, all about how it was entered in, financial statements, tax returns. So they're here just showing you the flow, how it works, okay? Then they're going to talk about different, if you remember from auditing, how you had to do before and after. You had to basically do testing, right? So you had to make these verification tests at the beginning of the proceeding and at the end of the proceeding in order to make sure to test these things. They're calculations of sort. And they talk about different ratios here: liquidity, operating efficiency, operating profitability, business risk, and financial risk. Okay, and these are all part of analysis. So in essence, these are the part of the analytical procedures that you do at the beginning and at the end. Okay. So liquidity ratios, I'm not going to go through all these. I assume you know them, or at least be able to calculate them, right? Efficiency ratios, you might not be as familiar with these. Well, actually, these two you should be anyway. Cost of sales, gross margin. Yeah, I would think you would know that coming in here. So again, can you calculate them? Business risk. Now these could be a little bit different. Something you typically wouldn't do: sales volatility, coefficient of variation, how far up and down from the average, degree of operating leverage. That's basically this has to do with how the company is capitalized. Did they borrow more money? How does it impact, a percentage up? How does that impact that? That you'd probably learn in managerial or cost accounting. Financial risk, debt to assets. This is all how much leverage are they using. Okay. All right. Now to the regulatory system. Who decides all this stuff? Statement of Auditing Standards number 99, Sarbanes-Oxley, Peekaboo, ERP, Enterprise Risk Management, Auditing Standards number 5 and 3, and the IIA's Practice Advisory. So we're going to take a look at those items. All right. So auditing standards for non-public companies. You have to have reasonable assurance that there's no material misstatement and professional skepticism, which I'm sure you're aware of, meaning, kind of trust but verify. We're going to see that. There's compilation and review standards. Those are two different types, where they're preparing financial statements. Compilations, just putting them together. Reviewing is saying that you did some test. There's other attestations, other types of tests that you could do. They talk about consulting standards and professional conduct. Okay, so this is for non-public. Okay, so again, why are audits performed? That they're fairly presented and free from material misstatement. Okay, has to be completed with professional due care. I'm sure you all realize that. But fraud, misappropriation, that could lead level of materiality, or material financial reporting fraud. By the way, any type of fraud is material. Okay, it says material financial reporting fraud. Once you find fraud at any level is material. Okay, and then the ACFE, asset misappropriations, fraudulent financial statements, and corruption. We've seen those before. So just remember, the minute you find fraud, it is material. By definition, fraud is material. Professional skepticism, I'm sure you've heard about this. Questioning mind, critical assessment. Dissatisfaction with less than persuasive evidence. So again, you have to go in there open-minded and critical. Okay, I'm sure you guys realize that. Probably had it in auditing. White-collar crime, they exploit your humanity. Trust but verify. Notice, it's a crime of deceit, and white-collar criminals are artful liars. They're used to lying. They're used to hiding. They're used to concealing. Remember, that concealment is what makes you know it's intentional. Okay? So, SAS 99. So here they talk about the 8-step approach to order to comply with that. States at the onset on engagement, they should undertake a staff discussion concerning risk. This is pre-engagement. They talk about risk. Gathering information to identify the risk. Identifying any kind of risk that could result in fraud. The auditors assess the fraud risk after considering the programs and the controls to prevent fraudulent financial reporting. So notice, this is a methodical type thing. You know, the first thing, you got to get the group together. Where are the issues here? Where could there be issues? Where would the issues be such that make it material? Number 5, specific responses to fraud risks. How do they test for them? Consider audit evidence and to continually assess fraud risk throughout the audit. Communicate the findings and ensure that the auditor has documented each step. An auditor, if nothing else, an auditor has to document everything. Okay, because, you know, again, sometimes clients, whatever, other people that rely on these things, they'll come back and try to sue you. So your best defense is you followed SAS 99. You followed the proper guidelines. And that's your argument. Your argument is, I did my job. Okay? So communication. All fraud to an appropriate level of management. All management fraud goes to the audit committee. It always goes to the next one up. All material fraud to management and audit committee. By the way, I disagree here. Any fraud at any level is considered material. Okay? If reportable conditions related to internal control environment have been identified, the auditor must communicate those. In other words, if you say your internal controls are not working, you need to tell them about that as well. Okay? Now, documentation. You have to document the discussion, what information you used, what you identified, how you assess the risks, the result of the assessment, the evaluation of evidence, and the communication. So again, it's imperative, if you are an auditor, having all of this documented is basically what saves you, and it allows you to say, we follow the rules of testing, and this is what we did. Because if somebody is committing fraud, especially regarding collusion or whatever, remember, the purpose of the fraud, the purpose of the audit is not to catch fraud. The purpose of the audit is to say that the financial statements fairly represent and that there's no that they're reasonable and does not appear to be material misstatement. The audit is not designed to catch fraud. People think that it is, but it is not. Okay, but nonetheless, you have to consider it during your audit. But that's not the purpose of the audit. Okay, Sarbanes-Oxley. I'm sure you probably know a little bit about that. Basically, higher standards. This happened after Enron with all the stuff that went on with that. Severe civil and criminal penalties for corporate wrongdoers. New protection for corporate whistleblowers. Again, basically as a result of Enron. Standards, procedures, disclosure. Okay, you can look at these implementation rules. Nothing too important there. A little bit more about retention of records, insider trading, non-GAAP measures. But this is what's important here. So notice here, audit partner rotation, auditor independence, services outside the scope. These are important. Any conflicts of interest, mandatory rotation. Let's see what else. 404, management assessment of internal controls. Disclosure of audit committee financial expert. So again, these are all super important. Now, all of this is important, all these different sections, but those are the ones that are highlighted. Okay, the ones I highlighted, those are super important. And hopefully you've heard about those in your other auditing classes. All right, folks, that's part 4. We'll be back with part 5 in just a minute.